Are we doomed? This is It's Contrarian. Welcome back to It's Contrarian, your channel for videos on the stock market. Today we will review the trends, technicals, and fundamentals. So let's understand what's the trend as of today. YouTube is more bearish as compared to the last 6 months. The Google search results look bullish compared to the last 6 months. CBOE put to call ratio is bullish. CNBC top headlines are mixed. The trend overall is mixed to bearish. So, what do you think the market makers will go for? Will they go with the trend or against the trend? Let's see. Let's look at the technicals. Here's a chart of all commodities put together. They are looking to break the 200-day moving average. That means we are entering a bullish phase for the commodities for the 3 to 6 months. So with this in the back of our mind, if we look at the machine positions, the biggest shorts are in palladium, soybeans, and natural gas. So a contrary approach would be to go long on all these three commodities. Let's see how they do over the next few weeks. Now here's a chart of the seasonal trend of S&P 500 over the last 7 years. And the trend is showing a sharp pullback till mid of August. This drop can be bigger than 5%, but let's not predict to what level the drop would be. We will see the machine positions and then take the strategy accordingly. This is because the commodities are entering a bullish phase and hence not the right time to plan for the doomsday. Other than this, next week is important since 65% of the S&P 500 will report by 29th July and 80% by August 7. The earnings from next week will dictate the trend in the next few weeks. Here is another chart showing how the options market are pricing the earnings releases. This is 2% upward as compared to the regular in the last 6 months, with 11% for Snap and 10% for Spotify, 10% for Facebook, and 6% for Google and Microsoft. Let's see how the earnings come and then fine-tune the strategy. Tuesday after market close will be Microsoft and Google, and Wednesday after market close will be Facebook. Fed will also make the interest rate decision on Wednesday. So whatever happens, we can see a much bigger or a muted reaction with the Fed decisions. So let's take a look at the market news. American Express fell down by 4% after the profit rise. Because the outlook is gloomy, it sets aside $1.2 billion for credit defaults as compared to $420 million a year back. That's 3 times increase and $58 million the previous year. China exports have gone down, and this is at the time where the world expected China to lift the recession fears globally. Same is the situation with the South Korea, especially the chips exports, because this means Nvidia outlook on AI and the chips business may not be as rosy as it seems. Student loan bills will cut $100 billion from consumer spending. Japan, the key point here is exports to the US does not seem to be on the upward trend. So clearly, the fundamentals do not seem to be good outside America. Let's take a look at how the news is projecting in the United States. US recession becomes closer call as economists rethink forecasts. Bloomberg survey shows firmer growth through the third quarter. Fed's preferred inflation gauge seen ending 2024 near 2% goal. Paradoxically, Hooper credits the Federal Reserve's steep rate hiking campaign for the reduced risk of a recession that helped re-anchor inflation expectations, increasing the chance price pressure can ease without meaningful decline in the economy. And economists surveyed by Bloomberg are growing more optimistic as inflation cools. The Personal Consumption Expenditure Price Index, that is the Fed's preferred inflation metric, is seen rising 2.2% in the final quarter of 2024, according to the July survey. Last month, economists expected 2.3%. Excluding food and energy, the so-called core PCE price index will likely moderate through the first half of next year by more than predicted last month. Economists also see the consumer price index cooling faster through the end of next year. The survey of 73 economists conducted from July 14 to 19 was taken July after the latest CPI report showed the US inflation rate slid in June to a more than 2-year low. Now, this is most important. That prompted many traders to bet that next week's expected interest rate hike by the Fed will be the last of this cycle. So, this is a very bullish indicator. Now, let's take a look at the CPI trends along with the gas price. There is a big similarity, and now natural gas is at near the lowest price and it can bounce another 50%, which means CPI can go up in no time. And this is another chart on US weekly bankruptcies. This is near the 2008 highs, and hence it is a risky time at this point, and recession is almost a sure thing. But that does not mean the stock market will be bottoming. So let's wait and see how this evolves along with the earnings. This we have come to an end. Thank you for watching. Thank you for listening, and I'll see you tomorrow.